conference. Let me welcome Tom Viniemont. Perfect. French name? Oh, sorry, I do apologize. Tom Viniemont, which is at the City University of Wisconsin, and he will entertain us on an anatomy of fundamental indexing. Quite interesting.
All right, thank you. It's wonderful to be in Venice. I was here one time before, 20 years ago. It hasn't changed. I like the old thing. That's the good thing. In Hong Kong, things change every 2 years. It's hard to find your way, although I had a very hard time finding the place in the narrow streets. But I'm here. Thank you for inviting me. So, what we are doing, and I'll immediately go to the first slide, is looking at an alternative way of basically forming a portfolio. Being the classic way, being just using market cap. And we know that market cap has some problems, and many of the providers of investment opportunities for clients are looking into alternative ways to do passive management, basically coming up with alternative indices. It's something that is not new, it's something that is kind of trending now. And what we do is look at a small portion of this, but we're not trying to say what is good, what is bad, but we're basically first addressing the problem that market cap indexing has. And what is that? Well, normally we think that if markets are efficient and cap is solving, then value weighting would be the optimal way to form a portfolio. Right. Now, one aspect that is a little bit tricky with this is that when prices are noisy, basically prices are wrong, they're either too low or too high for particular stocks, then that will lead to a loss of efficiency. And that will especially be so when these pricing errors are not all in the same direction. So it's not that the market is underpriced as a whole or overpriced as a whole, but when these stocks are kind of have errors which are idiosyncratic, which are for each stock individually, and are non-persistent. They basically, we had a talk about mean reversion, there's some kind of mean reversion in stocks. Now, fundamental indexing, and I call this here the fashionistas, FI stands for fundamental indexing, they argue that value weighting systematically will lead to overinvestment in underperforming assets and underinvestment in overperforming assets. And why is that? That is because there is something called drag, and I'll define this in a little bit, but if you just, the gut feeling is that when the prices are, when the error is negative, and so the stocks are underpriced, if you're going to weigh according to the market cap, obviously because the stock is underpriced, you're actually underweighting the stock. And when the stock is overpriced, it's one of these popular stocks, and it's way overpriced, then what you're going to do if you market weight, you're going to have a too high weight assigned to the stock that is overpriced. So when these errors disappear and suddenly everybody's realizing that that price was way too high, then that stock is of course going to underperform. The one that you have overweighted and the stock that was undervalued, you have that one underweighted. So actually what you have is a not very optimal portfolio because you're overweighting all the star stocks which are all too high in value, and you're underweighting all the, let's say, the dogs somehow that nobody has cared about, but which are undervalued. All right? So that's a problem. You don't want that when you are an asset manager. So fundamental indexing came as a solution for this, or at least one of the attributes of fundamental indexing is that they don't really have that problem. Okay. How can you avoid that drag? And drag is basically that expected missed return that you have because of these errors. How can you avoid it? Well, you can basically change the weights in a way that they're kind of mirroring the true values, but they're not related to the pricing error. Okay? So you're going to instead use the market cap, you're going to use some proxy that is also somehow saying how much weight you have to carry in your portfolio, but that weight is not having that same error. So your weights and your errors are not correlated. And that, theoretically, should make sure that the drag is disappearing, and therefore, you would theoretically have a higher return if you're using fundamental indexes. Okay, so that's relatively powerful from a theoretical point of view. What kind of other alternative weights can you think of? Well, most people use accounting-related data, all right? So you can, for instance, use sales, or you could use cash flow. You can use whatever you want, that thing that you think is a good measure for that. So there's papers before who did that, and then there's also other kind of alternatives which are not using accounting-based data. Basset and others have used lagged market weights. If you believe that in the past maybe the errors were also there, but maybe they are not correlated now with the current weights, or with what the current weight should be, the true weights, then you could use that. Or you could be very naive and use, for instance, equal weights. Right? You just basically don't estimate anything. You just divide by the number of stocks you have. Okay. The problem is, and you can see this very clearly with the equal weighting, is that you will have what we call style shifts. All right? You're going to have a lot of small stocks with large weights in your portfolio. We call that style. We know that small stocks are typically going to have higher returns, but there's more risk, whatever that risk is. We know that there are these kind of book-to-market effects and so on. So that's not really the drag that's being solved. That's just basically changing your portfolio style. Okay. So what we try to do is basically we're going to see if indeed fundamental indexing is contributing something extra next to style. Okay. We know there's going to be some style effects, but we want to see if actually this drag is going to disappear, and if that disappears, how large that effect is of the using the fundamental weights. Okay. So what do? Well, we use some data, of course, and we use the US stocks, total return data. We use the entire universe of US stocks, which includes also OTC data. I'm not sure how the survivorship bias kind of comes in here, but we tried at least to take everything into account. We use data from 1990 to 2009. There's a lot of messy data when you start to use all stocks, so we throw out penny stocks, caps under 10 million, crazy accounting data that doesn't make sense, so we have to throw these things out. And we have per cross-section about 4,000 stocks. We use kind of a monthly horizon, so we're rolling things forward on a monthly horizon. Now this is an academic paper with a lot of math, and I'm going to skip most of the math, and just if you are interested, you can download this from the website. Does this work? Actually, when you're going to use fundamental indexes, are you going to generate extra returns, regardless of whether it's style shifts or this drag avoidance? Well, what do we find? When we evaluate, we have about, these are monthly returns, so you kind of have to well, roughly multiply that by 12 to get yearly returns. We have valuated is yielding about 0.7% per month. Then if we are using fundamental weights, we have here book value that we use sales, and we use the cash flow. Actually, that's the absolute value of cash flow. Then the returns jump up. Okay, so hooray for fundamental indexing. They jump up for book value about 1% per month. And these are statistically significantly higher. All right. You can also in the last couple of columns, or the last two columns there, you have the extra return measured versus the benchmark. And as a benchmark, here we use conventionally, as in most academic statistics, the value-weighted index. Okay. Equally weighted also, of course. If you look at this, also is actually outperforming the value-weighted index. And then we have the lagged-weighted indexes, which are not really significantly higher. They're a little bit higher, but not significantly so. Okay. So far, the fundamental indexes premises are not controversial. What people are doing in practice seems to also make sense from our viewpoint, so that's good. And the conclusion is qualitatively correct. But that, of course, does not mean, and that's our focus of this paper, it doesn't mean that drag is actually disappearing, which is something that lots of people claim, that they're solving the drag problem. Okay? What we need to find out is whether this is some kind of a style thing. So the standard performance analysis which people do is a Carhart procedure, which is basically pharma and French 3 factors. And then we also have a momentum factor here. Okay? If we just do the pharma French factors, then there's a big hooray for fundamental indexing. Because what do you see here? Let's just focus on the left column. That's the alphas. We see positive alphas. Positive alphas means that I'm beating the market, even after correcting for small minus big and high minus low. Okay? Champagne. Now, when we do a Carhart procedure, and actually this is kind of a modified one, instead of putting the momentum factor as the fourth, we put in the reversal. What we see is that the champagne suddenly turns, well, it's not really from the French region, champagne, but it becomes a apple cider, okay? British champagne, no, it's from the UK. A smallish paper cup maybe, okay? Why? Because we see that actually the alpha suddenly become not significant anymore, and most of the effects are being driven by the reversals. Okay? Now that doesn't mean that drag is not present and that it doesn't get solved. But it's of course not very good news, because we found something that is kind of taking away the bubble effect of this fundamental indexing. Okay. So style seems to be a factor, but this is also, we realized that with using this extended data set, that also these standard performance analysis have a lot of problems. Okay. Things are varying over time. Typically these portfolios are built, if you're thinking about the pharma French portfolios, they're built so that the small stocks are not really taken care of very well. And we still have, if you look at the top corner, we still have, for instance, book value having significance in the alphas. And most of the alphas is still positive. So what we want to do is see whether now it's drag or it's style, and how much is going to be drag and how much is going to be style. Maybe it's just like, it's 50-50 or something. Right? So this is just one slide out of the paper that kind of visualizes this. What we do, and one of the innovative things, is that we're putting things in buckets. We have size buckets, so we're going to put all the stocks in size buckets, and then we're going to classify or use this fundamental indexing and looking per size bucket. So in that way, we're going to avoid having size effects actually being there. So we're basically going to correct for the style shifts and then see whether drag is going to disappear. Okay. Now, if we use book value, we use sales, or we use absolute cash flows, what we do see here is that normally, if everything would be according to market weights, we would have a horizontal line at 1. Okay? That would basically mean that all our buckets are according to size. Now, what we did here is now build the buckets not according to size, but according to book to market, according to book value, according to sales, according to absolute cash flow, and then see how much larger these stocks are than if you would just have them ranked up by size. And then we see, well, yes, well, we're basically overweighting a lot, because everything, I think from bucket 18 back to bucket 1, we see that there's overweighting in these stocks relative to size. So when you're going to use book value or sales or absolute cash flow, you're basically going to overweight a lot of the small stocks. So your portfolio is going to have a lot more small stocks than you would have with just the market caps. Okay? So that's a big style shift, of course. Now, our approach, and in the academic paper we have a theoretical session on this, which I kind of dropped, is that, well, we kind of also concede that the standard performance test problems, so instead of going to evaluate the FI's return, fundamental indexing returns by themselves, we're going to evaluate the claims that FI is making about the avoidance of drag, so about having the drag disappear. Okay. So the idea would be that if we avoid this market foundation error, we would be able to beat Soros and Buffett. So what we're going to do is look for a simple strategy that is going to avoid that market's valuation error, going to avoid the drag, but we're going to minimize the style shifts that we've seen in the previous graph. Okay? So I think that's a fair thing to do, all right? So we're basically saying we're going to have no more style shifts, or we have minimal style shift, and then we're going to see whether we can beat Buffett and Soros as of course an example. We look whether they're inside or not. So what do? We're going to use these alternatives instead of the fundamental indices. If you think about lagged market weights are going to be much more size consistent, right? I mean, if you're going to have Google prices from 1 month ago or from 3 months ago, right? Google was large 3 months ago, right? So we're basically going to have weights which are more or less in the same size category. It's simple. It will kill most of the correlations between these weights and the value itself, and so on. Okay, that's the first alternative we have. Then the second alternative is that we're going to first make the buckets according to size. So we're basically in bucket 1 we have the small stocks, and in bucket 20 we have the really large stocks. And then within the buckets we're going to do financial indexing, fundamental indexing. Okay. Or we're going to do within these buckets, we're going to give them an average weight. An average weight, well, that's of course, that's like equal weighting, but now we're not equal weighting over all stocks or over the entire universe, we're just equal weighting per bucket, so that average weight per bucket is going to be more or less representative of the size of all the stocks there. Okay. So again, we're avoiding that size bias. And then I already gave that away a little bit when I was talking in the second alternative. The third alternative is do the same thing against these buckets. That was actually an idea of one of our students. So this is work with some people from Leuven, and one of the students came to the idea to put in the buckets. We stole that idea, and now we try to make it straight, so that's good. We use the fundamental index kind of technique using the accounting data, and again per bucket, so we avoid having this size style shift. And then alternative 4 is that we use the lagged weights over buckets, so they're all a little bit more distant. All right. So what do we have here? Here we have the alternatives and the fundamental indexing per bucket. So if we look at equally weighted, okay? So let me just go a little bit slower. The red lines are fundamental indexing done just purely as it is. Okay, so we have these higher returns which we got at the beginning, and now we compare this to the alternatives, and the alternative we choose here is equally weighted per bucket and the lagged weights per bucket. So they should be imitating what we get from the fundamental indexing. But what we find is that the black line is very close to 0. And the blue lines are very close to 0. Which means that whatever we observe from fundamental indexing even if we have them in these size buckets, seems to be driven by style. Okay? It doesn't seem to be driven by drag. If we would be driven by the avoidance of drag, we would see that also the black line or the blue lines would be positive. Okay. So, our approach was we're not going to evaluate these returns as it is and then correcting afterwards with the four-factor Barber model, but the claims itself, and then we were going to see whether we indeed are beating Soros and Buffett, but we don't see Soros and Buffett. They're nowhere in sight, so the gains are not from avoiding the market valuation errors, but are pure style shifts. Why is drag avoidance quite limited? Well, theoretically we find that noise isn't just large enough to explain the extra returns that fundamental indexing provides. We would need 30% of errors, or more even, to get actually that effect, that style, or that we observing from using these fundamental indices as the proxies for weights. We also find that autocorrelation in the errors is too high. Now, if Google is always overpriced, or Facebook is always overpriced, and they keep on being overpriced, then you don't have that effect where you basically have this mean reversion going in all the time. So we need to basically find or have errors that are large and then go back to zero, or large downward and go back to zero, to have this drag avoidance methodology kicking in. All right. We also find that errors have a market-wide component, more so than an idiosyncratic component. That means that the entire market might be overpriced, the entire market might be underpriced, and of course the weights, if just everything is overpriced, are not going to be affected by that. How much time? 5 minutes, excellent. I have a long conclusion.
If you wanted to save time for questions.
Oh, I'm on track. So standard performance analysis, we say, is kind of unsatisfactory. That's why we actually did this alternative analysis, because it will depend on the model. The model depends if you use momentum effect, then you don't find anything. If you find standard reversal, then you do find things. What about time periods? It seems to be very dependent on what time period you're choosing. And it also assumes that you have a constant exposure to these factors, which is also something that's very dubious here. And actually, we think this might also be an issue if you're analyzing mutual fund performances. If there is if there's no constant exposure, then you might have results that actually are not very reliable when you're analyzing the returns on mutual funds. So our method might be something that is also useful for looking at other returns. The actual degree of the size correction recommended by fundamental indexing is far too large to just be a Bayesian correction. We didn't really talk about that. And it seems to be also unstable over time and across style classes. These lagged weights may avoid drag, but of course lagged weights, there's also a little issue with this, which we try to, which we're happily also conceding somehow, is that if you think about lagged weights, you bring in somehow the momentum or reversal strategy in your, by using these weights. Okay? So if I use 6 months ago's weights, and then there's some kind of momentum, then of course, if I have higher weights on stocks that have been doing well, then I'm still going to have higher performance later on as well. So there's a little bit of a tricky thing in this as well. And equal weighting, that will avoid, of course, drag by definition, because the equal weights are very naive and there's no error on them whatsoever. but of course that's at the cost of feasibility and gigantic style shifts where you have huge weights on even small stocks. These drawbacks can be largely avoided by forming the size Vigintiles being 20 buckets, as I have shown before. But we find that in our analysis that drag avoidance is not present or has no significant impact, either statistically nor economically. Therefore, the 3 to 4% extra returns on a yearly basis, which we saw from fundamental indexing, must be style-induced, basically meaning we can explain with factors that are already known. And that's my paper.
Thank you very much, Tom. Are there questions to Tom, Louis?
I invite you to read the paper.
Yeah, we all need to digest the paper, but actually, before that, I have a little observation which is not specifically related to what you have just presented, but in some sense, yes. Is that if you throw the global indices on what we are doing, should it be from the academic side or practical side? It's like we are all talking with one word, trying to define something that I still have problems to catch. Market. What the hell is the market? Overpriced, underpriced. And this try to solve a global problem. And should we have something which acts as a reference framework, it would be nice for everyone, right? And on the other side, the practical day-to-day business. Indices for a fund manager should more be a reference portfolio or a reference strategy within a dedicated local universe. Right. And so indices always have this dual behavior to use a marketing argument, global. It should be global to define the market and local to enable you to work. And that's why maybe it's such a complex field.
Right, so with this presentation, I definitely don't want to say that the fundamental indexing or using the indices is a bad idea. Let me be very clear about that. There are extra returns being made from using these fundamental indices. The only tricky point is that as a fund manager, I can be not a very good fund manager, but if I induce style shifts, I will have higher returns. But that's not because I'm better in picking stocks or it's better in building these indices. It's just that I have smaller stocks in my portfolio. Right? I mean, I can easily beat the market, the market. If I define the market as being the index that is based on market caps, right? So what we kind of want to say, or if you are going to have a particular style portfolio or you're using fundamental indices, what you should compare yourself with is something which is taking into account not only these data, but also taking into account, well, the factors that we know are influencing the returns. Okay. So, we only do a very small thing. One of the claims of these fundamental indices was, well, we're actually doing more than the style shifts because we are taking away this drag, we're avoiding the drag. And as far as we find, and of course we are not God, this is not really present if you do a very simple analysis.
Thank you very much, Tom. So now let me welcome the second speaker of this section, which is Andreas Schroeder, who is the head of quantitative model at Venice Asset Management, who will entertain us on the hedge fund replication, which quickly.